Today is Monday, the 9th of February 2026, and I need to share something with you that sounds so extreme, most people will dismiss it without investigation. Silver is currently trading at $76.89 per ounce. Gold sits at $4,966.2, and there is a convergence of technical, fundamental, and monetary factors occurring right now that creates a mathematical pathway to silver prices that seem impossible until you understand the mechanics behind them. I am not talking about silver doubling. I am not talking about silver reaching $200 or even $500 per ounce. The setup I am about to reveal suggests the potential for silver to trade at levels that would represent one of the most dramatic wealth transfers in modern financial history. And the mechanism that could drive it isn't speculation. It is mathematics, market structure, and historical precedent that most investors have never examined closely enough to understand. In the next several minutes, I am going to walk you through exactly how silver could reach five-figure prices, why the conditions for this scenario are being assembled right now in real time, what historical parallels exist that prove such moves are possible, and most critically, why the vast majority of investors, institutions, and even governments are completely unprepared for what is coming. Let's start with a question that will frame everything that follows. What happens when the world's financial system discovers it needs something that doesn't exist in sufficient quantity? Right now, across global markets, there is a quiet panic building among people who understand industrial supply chains. Solar panel manufacturers in China are securing silver commitments 18 months in advance at premium prices. Electronics producers are building strategic inventories despite the cost. Electric vehicle battery makers are locking in long-term supply contracts with terms that would have seemed absurd just 3 years ago. These aren't speculators buying silver hoping to flip it for a quick profit. These are industrial users who have run the mathematics on their production schedules and realized something terrifying. The silver they need to fulfill contracts already signed may not be available at any price if current consumption trends continue. Here is the specific problem. Global silver mine production is approximately 830 million ounces per year. That number has been essentially flat for the past decade, despite significant price increases during that period. Why hasn't supply responded to higher prices the way it should in a normal commodity market? Because silver is rarely mined as a primary product. Roughly 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. When a mining company is extracting copper, the silver that comes with it is valuable, but it is not the reason the mine exists. You can't simply increase silver production by drilling more holes. You need new copper mines, new lead mines, new zinc operations, and those projects require a decade or more from discovery to production. Meanwhile, demand has transformed from predictable to explosive. In 2020, total global silver demand was roughly 1.03 billion ounces. By 2025, that number exceeded 1.2 billion ounces. The trajectory is accelerating, not stabilizing. Solar panel production alone consumed approximately 180 million ounces of silver in 2025. By 2030, based on current installation projections and the complete absence of any viable substitute for silver in photovoltaic cells, that number is expected to reach 380 million ounces annually. That is one sector consuming nearly half of global mine production within 5 years. Electric vehicles use roughly 3 times the silver of traditional internal combustion vehicles. As the global auto fleet electrifies, this demand vector grows every single year. It is not cyclical, it is structural and irreversible. Artificial intelligence infrastructure is driving unprecedented data center construction. Every new facility requires sophisticated electrical systems where silver plays an essential role in connections, switches, and thermal management. Microsoft alone has announced plans for data centers that will require an estimated 15 million ounces of silver over the next 3 years. And Microsoft is just one company among dozens racing to build AI infrastructure. Medical devices, advanced electronics, 5G networks, defense systems, all of these sectors have silver requirements that cannot be reduced or substituted without fundamental redesign that would take years and cost billions. So we have structural demand growing at 5 to 7% annually, driven by technological transformations that are not going to reverse. We have mine supply that is essentially flat and cannot respond quickly, even if prices double or triple, and we have a gap that is being filled from above, ground inventories that are not infinite. This is the foundation. Now let me show you what happens when this foundation meets the monetary crisis that is accelerating in real time. The United States government is currently running annual budget deficits exceeding $2 trillion. The national debt has surpassed 36 trillion and is growing by roughly 1 trillion every 100 days. At current trajectory, Debt service costs have become the second largest line item in the federal budget, exceeding defense spending. Japan's debt to GDP ratio approaches 260%. The European Union is grappling with debt sustainability across multiple member states. The United Kingdom's fiscal position has deteriorated to levels that would have triggered currency crisis in previous decades. These aren't political statements. These are observable mathematical realities that every serious economist, regardless of ideological perspective, acknowledges as unsustainable. When government debt reaches levels where interest payments alone consume an ever larger share of tax revenue, there are only three possible outcomes. Default, which is politically impossible for major economies. Austerity, which means massive cuts to government spending that would trigger social upheaval and economic depression. Or monetary intervention, which means central banks create currency to purchase government bonds, deliberately devaluing the currency to make the debt burden manageable. They're choosing the third option. They have to. And that choice has profound implications for anyone holding assets denominated in fiat currency. When central banks engage in large-scale currency creation, the purchasing power of that currency declines. It is not a theory. It is mathematical certainty. More units of currency chasing the same amount of goods and services means each unit buys less. In this environment, investors historically flee to tangible assets that cannot be created at will by governments. Gold has served this function for 5,000 years. Silver has served this function for equally long, with the additional advantage of being both a monetary metal and a critical industrial commodity. Now, here is where the mathematics become extraordinary. The entire global investment grade silver market, meaning physical silver held in the form of bars, coins, and allocated accounts that could be sold to investors, is worth approximately $50 billion at current prices. For context, that is less than the market capitalization of a single large technology company. It is a fraction of 0.1% of global financial assets. It is smaller than the amount of money that flows into or out of equity markets in a single trading day during periods of volatility. What happens when even a small percentage of global capital decides it needs exposure to physical silver as protection against currency debasement? Let me give you a concrete example. Global pension funds manage approximately $50 trillion in assets. If pension funds collectively decided to allocate just 1% of their portfolios to physical silver, that would represent $500 billion of buying pressure entering a market with a total investable supply worth $50 billion. That is 10 times the available supply. Even if we assume generous elasticity and significant price, driven selling from existing holders, the mathematics of supply and demand would require silver prices to rise dramatically, potentially by multiples of current levels, just to balance that single wave of demand. And it is not just pension funds. Sovereign wealth funds manage over $12 trillion. Insurance companies hold roughly $35 trillion in assets. Central banks themselves are beginning to recognize silver as a strategic reserve asset alongside gold. The setup is this. Microscopic available supply measured against potentially massive demand from institutions that have barely begun to participate. Now let's examine the historical precedent that proves silver can move to levels that seem impossible until they happen. In January 1979, silver was trading at approximately $6 per ounce. By January 1980, just 14 months later, silver touched $50. That is a gain of over 730% in just over a year. What drove that move? A combination of monetary instability, inflation concerns, and concentrated buying from the Hunt brothers, who were attempting to corner the market. The monetary instability was real. Inflation was real. The concentrated buying created the parabolic final phase. But here's what most people don't understand about that historical episode. The Hunt brothers succeeded in driving prices higher because there was an underlying fundamental deficit. Industrial demand was growing. Mine supply was constrained. The monetary environment was unstable due to dollar devaluation and double-digit inflation. The Hunts didn't create the bull market. They accelerated its final phase by adding concentrated buying pressure to an already tight market. Today we have the same fundamental deficit, but larger. We have the same monetary instability, but more severe given debt levels that are multiples of 1970s levels adjusted for GDP. And while there is no single group attempting to corner the market, there are dozens of institutional buyers, hundreds of industrial users, and millions of individual investors, all competing for the same limited supply. The difference is that in 1979, silver's industrial demand was a fraction of what it is today. There were no solar panels. There were no electric vehicles. There were no smartphones or advanced electronics requiring silver in every device. The industrial bid that exists today is structural and cannot be eliminated by higher prices the way speculative demand can. So we have a setup that mirrors 1979 in its monetary dynamics, but exceeds it dramatically in its fundamental supply-demand imbalance. Let me show you the mathematical pathway to five-figure silver prices, because this isn't based on wild speculation, it is based on ratio analysis and historical precedent. The gold-silver ratio, which measures how many ounces of silver equal 1 ounce of gold, currently sits near 64.5 to 1. Historically, this ratio has averaged around 50 to 1 over centuries of data. But during precious metals bull markets, particularly during the final parabolic phases, this ratio compresses dramatically. In 1980, it briefly touched 17 to 1. In 2011, it fell to 31 to 1. Now let's run some scenarios that might seem extreme, but are actually based on historical ratio behavior. Scenario 1, gold advances to $8,000 per ounce, which would match the percentage gain from major base breakouts seen in previous precious metals bull markets. The gold-silver ratio compresses to 40 to 1, a level that is actually conservative compared to historical extremes. Silver trades at $200 per ounce. That is already a nearly threefold gain from current levels. But let's go further. Scenario 2. Gold reaches $12,000 per ounce. This would represent a significant but not unprecedented move in a commodity supercycle, particularly if currency debasement accelerates as fiscal deficits remain uncontrolled. If the ratio compresses to 30 to 1, silver trades at $400. Still not in five-figure territory, but we're getting closer to understanding the mechanism. Scenario 3. This is where it gets interesting. Gold advances to $15,000 per ounce, a level that multiple commodity analysts with decades of experience have suggested is mathematically probable if the monetary crisis deepens and central banks lose control of inflation expectations. If the ratio compresses to 20 to 1, a level it has touched during previous mania phases, silver trades at $750 per ounce. Now we're approaching territory that starts to feel extreme, but we're still using ratios that have historical precedent. Scenario 4. This is the scenario that sounds impossible until you understand the mechanics. Gold reaches $20,000 per ounce in a full-blown monetary crisis, where major currencies are experiencing rapid devaluation and central banks have lost credibility. The ratio compresses to 15 to 1, which has never happened in modern history, but which some analysts argue could occur if silver's industrial scarcity combines with monetary panic. In that scenario, silver trades at $1,333 per ounce. But even that is not the five-figure scenario. So let me show you the actual mathematical pathway. If we experience a true monetary reset where the current debt-based financial system reaches a breaking point, and gold is revalued dramatically higher to partially back currency issuance, the way it did under previous monetary systems. Gold could theoretically trade at $30,000, $50,000, or even higher. In nominal terms, if gold reaches $50,000 per ounce, a level that sounds absurd till you calculate what would be required to back even a fraction of existing currency supply with gold reserves. And the gold-silver ratio compresses to 20 to 1, silver trades at $2,500. If that same scenario plays out and the ratio compresses to 15 to 1 due to silver's industrial scarcity, creating a supply crisis simultaneous with monetary panic, silver reaches $3,333 per ounce. And if we get a true mania phase where ratio compression exceeds anything seen historically, because industrial users are competing with monetary buyers for supply that simply doesn't exist, you could see scenarios where silver temporarily spikes to levels that would have seemed impossible just months earlier. I am not predicting this will happen. I am showing you the mathematical pathways that exist if the conditions align. And right now, more of those conditions are aligning than at any point in modern financial history. Let me give you some concrete evidence from recent weeks that suggests we're moving towards shortage conditions faster than most people recognize. In late January, a major solar panel manufacturer in China attempted to secure 5 million ounces of physical silver for delivery over the next 6 months. They offered a 12% premium over spot price for guaranteed delivery. They were only able to secure commitments for 2.8 million ounces. The rest of their requirement simply wasn't available from traditional suppliers at any reasonable premium. That is not a speculative buyer being denied. That is an industrial user with contracted production schedules unable to secure the raw material they need. On the 3rd of February, the Shanghai Futures Exchange implemented new delivery rules specifically designed to prevent a squeeze in physical silver markets. Exchanges don't create emergency rules unless they're seeing stress in the underlying delivery mechanisms. COMEX warehouse inventories have declined 23% since mid-2024. More significantly, the inventories that remain are increasingly held in registered accounts rather than eligible accounts, meaning they're already committed to specific delivery obligations rather than freely available supply. The U.S. Mint suspended American Silver Eagle production for nearly 4 weeks in January. When sales resumed on the 1st of February, available inventory sold out in under 6 hours, despite purchase limits being implemented to prevent hoarding. Major bullion dealers are reporting that premiums on physical silver have expanded to $18 to $23 over spot price for retail products. When premiums reach that level, it signals that the paper price and the physical price are beginning to disconnect. In the London market, traditionally the most liquid physical silver market in the world, delivery times for large orders have extended from 3 to 5 business days to 3 to 4 weeks. That is a massive red flag suggesting available inventory is far tighter than official statistics indicate. Perhaps most significantly, on the 24th of January, the U.S. Treasury Secretary convened a classified meeting with defense officials specifically focused on securing silver supply for defense applications. When silver becomes a national security concern requiring cabinet-level attention, it is no longer just a commodity market. It is a strategic resource where governments may intervene to ensure domestic availability. These aren't predictions. These are documented events happening right now that validate the thesis that available silver supply is far more constrained than current prices suggest. Now let's talk about the mining sector, because this is where leverage becomes truly extraordinary. A silver mining company producing at an all-in cost of $22 per ounce and selling into a $77 market makes $55 profit per ounce. If silver rises to $200, the company now makes $178 per ounce. Profits have increased 3.2 times. Mining stocks typically trade at multiples of underlying profit. During bull markets, a 3.2 times profit increase could drive share prices 10 to 15 times higher. But here is where it gets interesting. If silver reaches $500 per ounce, that same mining company is making $478 profit per ounce. That is an 8.7-fold increase in profitability. Stock prices could realistically increase 30 to 50 times. If silver reaches $1,000, you are looking at profit margins that would make these companies among the most profitable businesses on earth. Stock price multiples in those scenarios could exceed 100 times current valuations. We've seen this exact pattern in other commodity booms. During the uranium supercycle of 2005 to 2007, uranium prices increased approximately tenfold. The best junior uranium miners increased 50 to 100-fold. In the lithium explosion that peaked in 2022, lithium prices increased roughly 13 times. Quality lithium mining stocks increased 80 to 150 times over a 3-year period. The companies positioned in the silver sector right now, particularly the unhedged producers with quality assets and stable jurisdictions, represent potentially the highest leverage to the scenario I am describing. But selectivity is absolutely critical. Many silver miners have hedged their production, which caps upside. Many operate in jurisdictions where governments could impose windfall taxes or even nationalization if prices explode. Many have management teams that will make poor capital allocation decisions even in a favorable environment. The opportunities lie with specific companies that meet strict criteria. Unhedged production so they capture full upside from price increases. Operations in stable countries like Canada, the United States, or Australia where rule of law is reliable. Management teams with proven track records and significant insider ownership. Strong balance sheets with minimal debt, and quality deposits in proven mining districts with expansion potential. These represent extremely high risk, extremely high reward opportunities, suitable only for the most aggressive portion of a portfolio. But for investors who understand the sector, can tolerate massive volatility, and have conviction in the underlying thesis, the potential returns are extraordinary. Before anyone rushes to allocate capital based on what I've outlined, there is a critical reality that must be understood and accepted. The path to the scenario I've described will not be smooth, it will not be linear, and it will test the psychological limits of everyone involved. Commodity bull markets are characterized by violent corrections that shake out weak holders. During the 1970s gold bull market that ultimately took gold from $35 to $850, there was a 50% correction that lasted 18 months in the middle of the advance. Imagine living through that. Prices have tripled. You are positioned in what will ultimately prove to be one of the greatest bull markets in history. And suddenly, you are watching half your gains evaporate over a year and a half. The media declares the rally finished. Analysts explain why the move was irrational and has now corrected. Your account statements show losses that test your conviction every single day. The investors who sold during that correction missed a subsequent move from roughly $125 to $850. They missed a nearly seven-fold gain because they couldn't tolerate the psychological pain of a mid-cycle correction. Silver will be even more volatile than gold was. Rick Rule, who has 50 years of experience in resource investing, states categorically that silver will experience minimum 30% corrections multiple times during any major bull market. And if we're talking about silver reaching four-figure prices, those corrections won't be 30% pullbacks from $100 to $70. They'll be 30% corrections from $500 to $350, from $1,000 to $700. The absolute dollar amounts involved will be psychologically devastating. Most investors will not be able to hold through that volatility. They'll sell at exactly the wrong time, locking in losses and missing the subsequent advance. This is why position sizing is critical. This is why understanding your own psychological risk tolerance is more important than any technical or fundamental analysis. And this is why the investors who ultimately profit from extreme scenarios are those with conviction based on deep understanding, not those chasing performance based on recent price action. Let's examine the broader economic context, because silver's trajectory doesn't exist in isolation. We're living through what may be the end stage of a debt supercycle that began in 1971, when President Nixon severed the dollar's final link to gold. For 50-plus years, the global financial system has operated on pure fiat currency with no tangible backing. This allowed governments to run persistent deficits without the discipline imposed by a gold standard. It allowed central banks to expand money supply at will without constraint. It enabled debt levels to grow far beyond what would have been possible under any previous monetary system. The result is a global economy built on layers of debt that can never be repaid in currency with equivalent purchasing power to when it was borrowed. The only way out is inflation, deliberate, sustained currency devaluation that erodes the real value of debt obligations while nominally allowing them to be serviced. Central banks understand this. Governments understand this. The policy choice has already been made, even if it hasn't been stated explicitly. We're going to inflate our way out of this debt crisis. What does that mean for tangible assets? It means nominal prices rise potentially dramatically, not because the assets themselves have become more valuable, but because the currency they're priced in has become less valuable. In this environment, silver has a unique dual role as a monetary metal. With 5,000 years of history, it serves as a store of value when fiat currencies are being debased. As an industrial metal critical to the technology that defines modern civilization, it has structural demand that doesn't disappear even if the economy weakens. This combination makes silver one of the most compelling assets for a scenario where monetary instability and technological transformation occur simultaneously, which is exactly the scenario we're living through right now. Let me show you one final piece of evidence that ties all of this together. Central banks globally have been accumulating gold at record levels for 3 consecutive years. In 2024 alone, they added over 1,000 metric tons to reserves. This is unprecedented in modern history. Why are central banks, the institutions that manage the fiat currencies driving the global economy, suddenly accumulating massive quantities of gold? Because they understand what is coming. They understand that the current monetary system is reaching end-stage dynamics. They understand that when the crisis accelerates, gold will be the ultimate reserve asset that allows them to maintain credibility and potentially back currency issuance. But here is what almost nobody is discussing. If central banks are accumulating gold as preparation for monetary instability, what happens when industrial users of silver realize they're facing a supply crisis in a metal that is essential for their operations? They start securing supply at any price. They start building strategic inventories. They start treating silver the way central banks are treating gold, as a strategic resource that must be secured, regardless of current market price. And when that realization spreads, when industrial buyers shift from just-in-time purchasing to strategic stockpiling, the available supply will be absorbed faster than most people think possible. We may already be seeing the early stages of this shift. The extended delivery times, the expanded premiums, the inability of major industrial users to secure the quantities they need at reasonable prices. These are all signals that the transition from normal market to shortage market is beginning. So let's bring all of this together into a coherent thesis. Silver is currently trading at $76.89 per ounce. The setup exists for a move that could ultimately take prices into 4 figures, and potentially higher if multiple factors align simultaneously. The fundamental deficit is real and widening. We're consuming 200 million ounces more than we produce annually, and that gap is growing as industrial demand accelerates, while mine supply remains flat. The monetary crisis is accelerating. Government debt levels are mathematically unsustainable, forcing central banks into policies that will deliberately debase currencies to make debt serviceable. The industrial transformation is irreversible. Solar, electric vehicles, AI infrastructure, advanced electronics, These demand vectors are growing and cannot be reduced without abandoning the technological progress that defines modern civilization. The available supply is microscopic. The entire investable silver market is worth roughly $50 billion. A rounding error compared to global financial assets. The historical precedent exists. We've seen silver rise over 700% in 14 months during previous monetary crises. We've seen mining stocks rise 50 to 100-fold during commodity supercycles. We've seen ratio compression take silver to levels that seemed impossible before they happened. The mathematical pathways are clear. If gold revalues higher due to monetary crisis, and silver's ratio to gold compresses due to industrial scarcity, the nominal price levels that become possible extend well beyond what most investors currently consider realistic. The early warning signals are visible. Physical shortages are developing in retail markets. Industrial users cannot secure supply. Exchange inventories are declining. Governments are treating silver as a strategic national security concern. For investors who understand the setup, who have studied the history, who can tolerate extreme volatility, and who can maintain positions through violent corrections, what is unfolding right now may represent one of the most asymmetric opportunities in modern financial markets. The scenario I've described won't unfold in a straight line. It may not unfold at all if the monetary system stabilizes, if industrial demand plateaus, or if major new supply sources are discovered and brought online quickly. But if the trajectory we're on continues, if debt levels keep growing, if currency debasement accelerates, and if industrial demand keeps rising while supply remains constrained, the mathematics lead to outcomes that most people aren't prepared for. Not prepared psychologically, not prepared in terms of portfolio positioning, not prepared in terms of understanding what is actually happening as it unfolds. This is the $100,000 silver setup. Not a prediction, not a guarantee, a mathematical possibility created by the convergence of factors that haven't aligned this way in modern history. The question isn't whether it will happen. The question is whether you understand the mechanics well enough to recognize it if it does, and whether you are positioned appropriately for your own risk tolerance and investment objectives. If the scenario begins to unfold, the setup is visible, the evidence is mounting, and the timeline is compressing. The vast majority of investors, institutions, and even governments remain completely unprepared for what the mathematics suggest is possible. Subscribe so you don't miss any updates.